Good afternoon, and welcome to the AFS Best Practices Leadership webinar. Thank you for joining us today. Our topic is Pricing Fundamentals, a review of the 2021 commercial lending landscape. This webinar will be approximately an hour long, and our speakers today are Don Dougherty, Jeremy Charlson, and Rob Lynch. Before we get started, there are just a few reminders for today's event. We are going to have a poll, so we would ask for your participation when that poll is presented. Secondly, we encourage questions. Please use the Q&A feature to ask your questions. We will leave time at the end of our prepared remarks to answer as many questions as possible. And lastly, we are recording today's session, and tomorrow you will receive an email with a link to listen or download the presentation. Again, thank you for joining us. Don?
Thank you, Renee. Hello, everyone, and welcome to our webinar, Pricing Fundamentals, a review of the 2021 commercial lending landscape. We here at AFS know how busy all of you are, and we really appreciate you taking the time today to join us. As we get started, I want to say that we certainly welcome any comments any of you may have on today's webinar. Our contact information is provided at the end of this presentation, so please do not hesitate to reach out with your questions. It is worth noting that the source of the data presented today is from the AFS Pricing Service. This database is the industry source of pricing trends for commercial lending and contains over $1 trillion in commitments, with approximately 80,000 new and renewed loans being added to our database each quarter. This database is also used to prepare our Pricing Trends monthly newsletter. Again, please reach out to us if you are interested in learning more about our pricing service or if you are interested in receiving our monthly newsletter. Moving to slide 4, our agenda today covers 3 main themes. First, we'd like to examine the broader market and economic forces shaping commercial lending trends. Several reports point to an economy that is heating up. The fourth quarter represented the strongest quarter in 2021 for GDP growth, and inflation is running well above the long-term average. Higher inflation is generally seen as a positive for banks, raising net interest income and boosting profitability. All in all, the year ended with signs of an improving labor market and a strengthening economy, which are 2 factors that are often correlated with a rebound in commercial lending. That rebound appears to have already begun as we saw a surge in C&I loan balances at the end of the year. This increase and its distribution across industry and geographic segments will be spotlighted in the loan growth section of today's webcast. Many of you have asked us for an update on line of credit utilization, specifically regarding whether utilization rates have normalized to pre-pandemic levels. We'll provide some color on this topic as well. We will also examine recent trends in pricing, spreads, and fees for new and renewed loans. Many of you know that December was the deadline for banks to transition away from LIBOR to SOFR and other floating rate alternatives. As expected, we observed a significant rise in December in the volume of loans tied to SOFR. In today's presentation, we will contrast the differences in LIBOR and SOFR loans in order to better understand how the migration to SOFR will affect commercial loan pricing trends in 2022. On slide 5, we illustrate exactly what we mean when we say that the U.S. economy is heating up. As shown on the far left, real GDP increased at an annualized rate of 6.9% in the fourth quarter, which was the highest quarter in 2021, and a figure that beat the initial forecast of somewhere in the 5% range. GDP is the macroeconomic indicator most highly correlated with commercial loan growth, so the results this quarter bode well for the growth outlook at most banks. The middle graph plots the Business Confidence Index, a survey-based metric designed to capture the overall U.S. business outlook based on responses involving production, orders, and stocks of finished goods. The COVID variants did weaken business confidence relative to the levels reported at the start of 2021. However, when viewed over a longer horizon, business confidence at the end of 2021 was at least on par with the pre-pandemic level and well above the long-term average. This trend also bodes well for the forecast of commercial loan growth. Measures of inflation are presented on the far right, and the results here are a bit of a mixed bag. High inflation curtails consumer spending, which consequently hurts the sales numbers of businesses that borrow from banks. That being said, high inflation has in years past helped spur an increase in corporate borrowing by firms looking to lock in advantageous pricing before the Fed raises interest rates. Higher policy rates should in turn help improve banks' net interest margins. Next, on slide 6, many of the themes are encapsulated nicely by this article from Reuters. The article predicts that 2022 will be the year banks see a resurgence in their bread and butter business, which refers to commercial lending. This resurgence will take the form both in higher loan volumes due to economic growth, as well as higher net interest income brought on by the Fed rate hikes expected this year. What's most interesting here are the remarks from JP Morgan, who is often seen as a bellwether for the broader banking industry. The bank expects that the bulk of its increase in net interest income should come from organic loan growth, not from the interest rate hikes. If this statement proves accurate, then the industry is poised for a loan growth rebound in 2022. Examples supporting this anticipated rebound in loan growth include commercial borrowers who experienced supply chain disruptions in 2021 and are now looking to rebuild inventories, along with cautious optimism about the economic conditions in 2022. While there's much to be excited about in 2022, there are several important qualifications to bear in mind. On slide 7, we identify the headwinds or challenges associated with each favorable trend. So on the positive side, we have already mentioned the strengthening economy, rising business confidence, and the potential for Fed rate hikes to boost net interest margins. You can also add fewer problem loans to this list. On the negative side, some banks we've spoken with believe that December's rise in C&I balances may have at least partially benefited from a pull forward of early 2022 planned drawdowns. And the Fed interest rate hikes anticipated this year may also have an adverse impact on credit quality, especially in sectors such as leisure, accommodation, and real estate, where debt service capacity of some borrowers is already strained. Finally, the pandemic and all the uncertainty and disruptions it has created and continues to create. This includes supply chain issues, which are by no means fully resolved. COVID-19 will continue to create frictions in the economy and, by extension, the commercial loan market. So let's see how these forces have impacted recent trends in commercial loan growth. For that part of today's presentation, I turn it over to Jeremy for an in-depth view of loan growth. Jeremy?
Great, thank you, Don. Appreciate that update on the broader economy. And Lisa, if you go to the next slide, please. So I think the biggest takeaway and the one most relevant for the loan growth stats we'll examine is that the economy on balance is still pretty healthy, and it's actually strengthening in some cases, as Don showed. So 4Q GDP in particular, that was really strong, a lot stronger than anticipated. And that increased level of economic activity appears to have fueled a resurgence in commercial loan growth. So here we've plotted the long-term trend in monthly loan growth rates. And note the C&I line, the blue series on that trend chart, that does include Paycheck Protection Program loans, which accounts for some of the volatility that we're seeing in recent months. So for those of you that have joined us for previous webcasts, you've probably seen this picture before, and your eyes are probably once again drawn to that big spike we see in 2020. And during that time period, we had two events that fueled that increase. One being at the start of the pandemic, a lot of companies, especially the larger end companies and corporate borrowers, they drew down on lines of credit to shore up cash at the start of the pandemic. And then shortly after that, we had the launch of the Paycheck Protection Program. So those two forces really helped contribute to that big spike in the 2020 timeframe. I think the more relevant finding, though, for today's call is actually the data point at the far right of that trend. So C&I outstanding balances increased 2.87% month over month in December. And with the exception of that 2020 blip that I just mentioned, that was the strongest growth rate recorded for any month over the last 20 years. And I think what makes that figure even more impressive is that it represents the runoff in the PPP balances. So if we were to take PPP loans out of the mix, growth in December is actually higher than 2.87%. So I think the key question here is exactly why was December so strong? And I think the answer goes back to the economic trends that Don presented. There's a general feeling that even with Omicron, and now I think they're calling it stealth Omicron, the worst is behind us and businesses are feeling a bit more optimistic about economic growth. Some borrowers tapped lines of credit to rebuild inventories. Don mentioned the supply chain issues that we experienced last year. We've also heard some anecdotes that some borrowers tapped lines of credit to finance dividends in December. Another theory is that some businesses actually rushed to borrow in December ahead of the conversion to SOFR. December was the last month that banks were advised to make LIBOR loans, and we definitely continued to see a lot of LIBOR rate pricing, especially in the syndicated end of the market. While not quite as impressive, CRE balance growth was also pretty robust in December. CRE balances were up 1.07% in December from month-end November. You can see the more recent increases plotted as dollars on the right-hand picture, along with slopes in the trend lines. You can see both C&I and CRE did have a pretty impressive quarter, the fourth quarter that is. So hopefully banks will be able to build on this momentum as we head into 2022. And next slide, please, Lisa. So for a while, the Paycheck Protection Program was really the only source of loan growth for much of the industry. And conventional commercial lending, especially bilateral lending, had been down relative to pre-pandemic levels. Thankfully, banks are once again growing the balance sheet with conventional commercial loans. You can see that represented here on this particular diagram. So for this chart, we compare growth in each month to a December 2019 baseline, using that kind of as our index for the pre-pandemic average. So a value above 100 means that balances were X% higher than they were in December 2019, while a value below 100 means that balances were X% lower than where they had stood prior to that same month. The orange series here actually excludes the PPP activity, so we get a more precise picture of what conventional loan growth has been over the last several months. You can see that for most of 2021, total balances excluding PPP loans actually trended beneath the pre-pandemic level. It's possible that at least in the smaller end of the market, PPP reduced demand for conventional C&I loans. But I really think that dip and that tepid growth in all loans excluding PPP really reflects the retrenchment that we saw for many periods following the onset of the pandemic. Thankfully, though, beginning in October of 2021, the trend finally surpassed the level that we last saw before the pandemic. And then, of course, we had this really impressive growth in December. So by the end of 2021, total balances without PPP loans were actually 3.1% higher than they were versus the pre-pandemic average. So definitely a trend in the right direction. Again, there are some headwinds that could impact that in 2022, but certainly a more favorable finding than we had reported for much of the year. And next slide, please, Lisa. Now, one of the first and most heavily impacted sectors by the pandemic and the measures to control the pandemic was the real estate sector. According to the National Association of Realtors, 2021 was actually a major year for the commercial real estate market, particularly for the multifamily and the industrial subsectors. Their December report highlighted a record low vacancy rate for multifamily, complemented by asking rent growth of 11% year over year. These favorable fundamentals are reflected here in this loan growth chart, where we compare year-to-date, or we measure year-to-date growth rates for various CRE loan products. CRE balances for the multifamily category, which is the orange series on this chart, that expanded 7.12% year over year, which was the highest growth rate of the various CRE segments plotted. The green line here, which is the non-farm, non-residential segment, that's a broader catch-all category that includes loans secured by hotels, nursing homes, warehouse facilities, and retail. The growth in e-commerce that the pandemic has helped fuel has led to significant growth in CRE lending to industrial properties, and it was growth in that particular property type that was a major reason for the upswing in that green series here. Now, certainly there are some headwinds for CRE lending. Retail delinquencies, surprisingly, they've been really low, even through the peak of the pandemic, but the outlook for brick and mortar, that still faces a lot of structural challenges, and it's really uncertain what that's going to look like years down the road. The same can be said for the office property type, whose outlook's complicated by a hybrid working model is really becoming norm for a lot of companies. With that said, as with the C&I picture, there is a general feeling of optimism when it comes to CRE lending. According to banks surveyed by the Federal Reserve in their senior loan officer survey, most are reporting increased demand both for construction loans as well as for investor CRE, so that bodes well for the outlook in 2022. Next slide, Lisa. So here we'd like to take a moment to poll the audience on the levels of loan growth they've been experiencing. So as we said, December was a really strong month in our data. Curious to see for your bank how you would characterize new loan growth, commercial loan growth specifically at your bank relative to 6 months ago. Is it really strong, meaning maybe more of a 10% or in excess of 10% increase? Would you characterize it as modest, being in the low to mid single digits, or do you think it's weak and largely unchanged from earlier in the year? So we'll give you a couple moments here to see the levels of loan growth that your bank is experiencing and how that might relate to some of these market trends. And I see a few. Oh, go ahead, Renee.
No, I was going to say, I think we can close the poll. It looks like we've gotten some responses here. Are you good?
Okay. I am good. Yeah, let's see the results.
Oops, sorry. And here we go.
That's actually a little bit surprising to me that no respondents said their growth was strong. I know December was really strong for most of the banks that we're working with. It could be that maybe they were seeing more modest growth when you exclude PPP. Maybe they're focused more on the manufacturing industry, which I know had some supply chain shortages. Surprised too to see that a lot of the growth was characterized as weak. Now, as you'll see in the next few slides, these trends can and do vary greatly by geography. So depending on where your bank is located, that certainly could impact the level of growth that you're seeing. So at that point, if we go to the next slide here, we actually take a look at some of that growth by geography, and you'll get a sense now for just how much the results can vary when you look at it by state, and in a moment when we look at it at a local market level. Now, a lot of the states were up in December. What we're doing here on these charts is we're ranking the top 5 states and the bottom 5 states for C&I bilateral loan growth with a month-to-month picture on the left and a year-over-year perspective on the right. And so what we're seeing for the month of December, looking at that left-hand view, is that New York saw a really strong resurgence in C&I loan growth month over month. In the month of December alone, they grew over 5%. So it's a really strong figure on an annualized basis. New York has a lot of exposure to the finance and insurance industry. And this is a sector that we've touched on quite a bit in our webinar series. The types of activity in the finance and insurance sector, or F&I for short, that includes companies like private equity, venture capital firms, mortgage companies, and other non-bank intermediaries. And it appears that these firms have been very active recently in purchasing or investing in companies while valuations are still cheap. We also saw quite a bit of growth this month in Texas. Before drilling into the details, I first thought that might have been from the energy sector. I know oil prices, and I think the WTI in particular, had a really strong rally the last few months, but it actually was not the energy sector. Loan balances in the energy sector actually declined by a very large margin in Texas over the last year, and in the month of December in particular. Instead, in Texas, we're seeing a lot of growth in finance and insurance. So again, that sector coming up, the professional services industry, as well as the auto sector. Then on a year-over-year basis, we also saw 3 states with double-digit increases in December, those being New York, Texas, and Florida. But you can see there were some states that actually had a pretty deep retrenchment in C&I balances. So going back to the poll, when some company or some banks were saying, my growth for my bank has been weak over the last 6 months. Well, if you're located, say, in the Midwest, around the Minnesota area, or perhaps out west around Washington, certainly demand there has not been as robust as we're seeing in some other states. So really shows you the importance of breaking out these trends by state and by industry, because depending on your mix and your footprint, you could be seeing very different results from the national trend. Next slide, Lisa. Now, an important feature of our service, of our pricing dashboard service, is that we can actually drill down to a core-based statistical area level. So kind of looking at local markets and how trends might vary at a micro level. And for any charts that you see here in this deck, I want to point out that if you subscribe to our service, you could filter for any growth view, any pricing or fee view, fee chart, specifically for your bank's footprint or the cities that comprise your bank's footprint. So we can really personalize the analytics to meet your needs. The map and the bar chart here, they're really one and the same. The size of the bubble on the map on the left reflects the growth rate plotted on the bar chart. And what we did here is we've listed the 20 largest cities in our database in terms of C&I bilateral volume, and then ranked them low to high by their month-over-month December growth rates. So on this list, we have areas like DC with a lot of growth. And what's really interesting here is actually, if you look at the metros here, there was a 3 percentage point standard deviation across the metro. So again, the growth can vary widely depending on where your bank's located. Again, we have areas like DC and Tampa that had really robust growth in the month of December. Conversely, there were some areas like Detroit and Birmingham that actually had a retrenchment in growth, or areas like Baltimore and Atlanta that, while positive, really were beneath the national average this month. The variation here, that can reflect a number of drivers. It could include the strength of the local economies, the number and size of banks that predominate within them, as well as the mix of industries and borrowers within them. So again, New York, for instance, which is fourth from the bottom there, having shown a really high growth rate. Again, that's because of New York's exposure to the financial sector, which we've highlighted as a real major loan growth driver in recent months. Next slide, Lisa. So speaking of the finance and insurance industry, or F&I for short, that's a segment that's been leading industry C&I bilateral growth for a while now, and you can really see that more explicitly here on slide 15. This is a similar look to the state view, where we have the month-to-month comparison on the left, and then the year-over-year look on the right. And you can see that both month-over-month and year-over-year, It's finance and insurance that's leading C&I bilateral growth in December. We did drill into some of the subsectors here. Unfortunately, it wasn't too revealing. The top subsectors were other investment pools and funds, other financial investment activities, and other non-depository credit intermediation. So a lot of other detail, no pun intended, to say the least. We were able to look at some of the borrower names, though, and a lot of the borrowers that we saw were private equity firms, alternative investment management companies, real estate financing companies, and providers of personal loans that cater to subprime customers. What's interesting is that while the banks that lend to these finance companies often risk rate them favorably, these financial intermediaries often specialize in risky transactions. So commercial banks are in some ways indirectly exposed to asset classes that might not be favorably viewed by regulators. The delinquencies and the non-accruals for these financial loans, they've been pretty low, so the credit quality has been good, but it's definitely a trend you want to be mindful of. This is a sector that you're growing very heavily in your bank's commercial portfolio. Also seeing too the manufacturing industries showing some pretty robust growth both month over month and year over year. That could be because of the supply chain issues. Maybe they had to tap lines of credit to cover maybe shortages or while they're waiting for materials. So I wouldn't be surprised if that's been a factor for some of the growth we're seeing for those industries. Thank you, Lisa. So another interesting and rapidly evolving loan growth dynamic is lending for green and sustainable purposes. We get a lot of questions about this. What kind of growth are we seeing for green loans or sustainable loans? The chart here, I should mention, this is a trend from Bloomberg. It is global issuance, so it's not just US banks, and it encompasses more than just commercial loans. It's a lot of different bond and loan varieties and capital markets. The trends here are indicative of what we're seeing in the commercial loan space. You can see here just how rapidly these loan and bond varieties are growing. 2021 was a record year. It more than doubled issuance in the previous year. In particular, we're seeing a lot of growth in that yellow series, which stands for Sustainability Linked Loans, or SLL for short. Those are loans where the pricing is tied to some type of sustainability target. So an example could be where the loan spread actually declines 1 or 2 basis points each time the customer reduces emissions by some predefined amount. It's a really exciting loan type and one that a lot of banks are now trying to incorporate as part of their product offerings. Their flexibility makes them really exciting. However, it also creates a number of data and operational challenges for banks that need to embed new and custom data points into loan agreements. So looking at the attendees list here, I can see that several banks in the line are AFS clients. I want to point out that banks running our AFS Vision loan accounting system can actually create and define custom fields. That's really important here because that functionality allows the application to be responsive to new data gathering needs, such as those related to sustainable lending and green loans, without the need for additional code releases or deliveries. So if you're interested in growing your ESG portfolio, I'd certainly encourage you to reach out to us and see these capabilities in action. It can really help you grow that exciting new loan type. And you can see the demand there is definitely there for green and sustainable lending. Now, leading up to this webinar, we get a lot of questions about line utilization. It's been a hot topic for a while now. For a while, that metric has been pretty stagnant. We hadn't seen a lot of uptick. It really came down following the onset of the pandemic. Thankfully, we are seeing some signs of life here for utilization. So for the fourth quarter, if you look in that left-hand trend chart, in the fourth quarter, both bilateral loans and syndications saw more than a 2 percentage point increase in their respective utilization rates. That's a big reason for why outstanding balances grew so heavily in December. We saw utilization finally start to tick up. I should note it's still not quite where it had been before the pandemic. You can kind of get a sense now for that perspective on the right-hand chart. We actually look at year-end 2019, year-end 2020, and then year-end 2021. We're definitely ahead of where we were at the start of the year, but we're still a few percentage points beneath the December 2019 average. I think the reason for that is that a lot of companies are still flush with cash. I do know that we've seen some corporate borrowers actually pay down bank lines to refinance in the bond markets. That could be another factor that kind of held down utilization, but it's nonetheless encouraging that finally that trend is starting to increase, and hopefully we'll continue to see some upward momentum in 2022. Now, of course, the utilization trends are not uniform across the industry. In fact, we saw a number of industry subsectors, of three-digit NAICS subsectors, where utilization increased very, very quickly throughout 2021. And what we've done here is we've actually listed the 10 industry subsectors with the largest year-over-year change in their utilization rates. What's notable here is that 7 of the 10 actually have a 3 at the beginning of their NAICS number. That means they're a part of the manufacturing industry. Again, it could be that maybe some supply chain issues forced them to tap lines of credit. 2 here are notable in particular. In the middle of the graph, we have computer manufacturing and then plastics and rubber. They're notable because they actually now have utilization rates that are above their pre-pandemic average. So not only do they see big increases year over year, they're seeing utilization well above their historical means. The subsector with the largest year-over-year change was actually animal production, which is an ag sector. That's plotted second from the left on this diagram. Now, I think the utilization rise there, it might not actually be a great thing. Non-accruals and delinquencies really have been rising in that chart. I don't fully know the story for why that is or what headwinds are impacting that sector. But I think the reason why utilization is increasing so rapidly is it could reflect some credit distress for borrowers in the animal production subsector. Hi, Lisa. Now, higher utilization wasn't the only thing driving December's increase in loan balances. We also observed a really sharp rise in new loans, meaning new term loans or new draws under new lines of credit. Now, we should mention that December, from a seasonality perspective, is usually a really strong month for new lending, but this December was exceptionally strong. You can see that on the trend chart on the left, where new volume really surged from November to December. In fact, for the fourth quarter, kind of taking a bit of a longer term horizon there, for the fourth quarter, new volume was up more than 50% when compared to the same period a year ago. So again, it really shows you just how strong this particular December was, probably reflecting the strong economy that we're beginning to see finally take shape. Renewed deal flow, which is the orange series on this chart, that wasn't quite as impressive as the new loans, but we still did see a pretty meaningful increase. And in fact, the renewal activity in the fourth quarter of 2021 exceeded the year ago period. So from a new renewed perspective, again, we're seeing some pretty positive signs in terms of loan growth. Hopefully that will continue into 2022. And then finally, just wanted to show you how the mix of new renewed volume may have changed this year, or 2021, versus the preceding year. Rob will go into this a little bit more from a pricing perspective. Certainly in terms of indices and rate types, seeing a lot more SOFR volume. But what really caught my eye from an industry perspective was that if you look at the mix of sectors in 2021 versus 2020, you really see some very significant migration with some significant increases in the finance sectors. We've highlighted those with that red box here. The new renewed volume for finance and insurance really has been increasing. Again, for your reference, many of these borrowers are private equity firms and non-bank lenders that cater to riskier borrowers. So the growth here, again, it might be indirectly exposing banks, borrowers, and asset classes vulnerable to another economic shock, similar to what we had observed and lived through in 2020. I'm not implying anything imprudent here, but it's definitely a trend to keep an eye on as banks increase their lending and if they continue to grow so rapidly in the finance and insurance sector. So it's definitely been a unusual December in many ways. Thankfully, many good ways. We're seeing really strong loan growth. But to show you more detail in terms of the returns we're getting on those loans, the pricing and fees of new renewed loans, I'm going to turn it over to Rob Lynch for that component of the analysis. So Rob, take it away.
Thank you, Jeremy. Good afternoon, everyone. Looking at pricing for new and renewed loans, we continue to see very little movement quarter over quarter. The chart on the left shows the interest rates for new and renewed bilateral loans excluding PPP, and rates have been in a narrow range all year. The chart on the right shows interest rates on participation decreasing over the last year by between 50 and 75 basis points. In December of 2021, interest rates for new participations decreased to their lowest level seen in the last year, and while renewals are slightly higher during the quarter. Next slide, Lisa. We're going to take a look at interest rates by term in the left-hand chart and risk rating in the right-hand chart. The loans with terms between 5 and 10 years, shown by the green line in the left-hand chart, experienced the largest decrease in the quarter. It was close to 30 basis points. Those loans with a greater than 10-year maturity outpaced the shorter-term maturities by between 50 and 110 basis points during the quarter. On the risk rating side, risk ratings 5, average risk, and 6, acceptable risk, shown in the right-hand chart by the yellow and turquoise lines. They were very stable during the last half of 2021, ranging between 2.5% and 2.9%, while better credits were only able to get to at most 2% during that same time period. Next slide. The next slide shows a breakout of loans by type over the last year. The top chart on this slide shows the breakdown for all loan types, and as you can see, in the fourth quarter, the share of LIBOR loans dropped significantly to just over 52%, while SOFR has close to 25%. Looking deeper into this mix, we see in the lower left-hand chart this same breakout for bilateral loans. And for this population, SOFR loans are up to approximately 1/3 of the volume, just behind LIBOR. Looking at participations in the lower right-hand chart, LIBOR is still the dominant index, capturing 76% of the volume. It is encouraging that SOFR is the second highest utilization rate at 13%. It's clear that to this point, participations and syndications have had a preference to using LIBOR, and it will be interesting to see how this changes now that LIBOR is discouraged for new originations. As we see SOFR making inroads, especially in the bilateral space, we wanted to show the types of SOFR being used. And this slide shows us that as of now, SOFR daily and SOFR term rates are the most used, with 85% of the loans using one of these two rates. SOFR compounded in advance follows at a distant third, with only 15% of the volume through December 21st. As the market matures, we'll continue to monitor this for future trends and see if a particular type of SOFR rate becomes more the market standard. On the next several slides, I'm going to take a look at LIBOR and SOFR performance over the quarter. And on this first slide, LIBOR loans are shown in the left-hand chart and SOFR loans are in the right-hand chart. The blue bar represents the weighted average interest rate and the orange bar represents the weighted average spread. There are two things I want to point out on this slide. The first is that there is not much difference between the two indices during these 3 months. November was the month with the most difference, while in October the indices were almost identical. Secondly, notice that SOFR interest rates increased over the course of the 3 months, going from 192 basis points to 214, while LIBOR had some fluctuation over the period. It did hit a high of 222 basis points in November. On the next slide, LIBOR and SOFR loans are shown by deal size in the left-hand chart and risk rating in the right-hand chart. What comes through on these charts is that the indexes are remarkably similar, both in volume distribution, shown by the blue and orange bars, and interest rate, shown by the blue and orange lines. You can see that interest rates for deals less than $1 million showed the greatest divergence, but note that there was very little volume in this space during the quarter, and that usually leads to more fluctuations in rate. And while the risk rating chart on the right shows volume distribution and interest rates that are almost identical between SOFR and LIBOR. On the next slide, we took it a step further and broke out LIBOR and SOFR by industry. Once again, the balance distribution is very similar. The majority of LIBOR balances are concentrated in two industry sectors: finance and management of companies, and retail and wholesale trade. SOFR balances also have a large percentage in those same two industries, but they also have notably larger balances in healthcare and other industries. Rates charged on these loans are again very similar, with the notable exception of mining and transportation. But you'll look and see that that particular industry does not have a lot of volume in the quarter. And again, that lack of volume typically leads to a little more variation in interest rates. So from these slides, these last three slides, one can draw the conclusion that SOFR is indeed functioning similarly to LIBOR and is a very good alternate rate, at least based on the loans in the fourth quarter. Next, we'll turn to fees. And on this slide, we show upfront fee incidence in the left-hand chart, and it decreased for both new and renewed loans over the quarter, despite the small uptick in December. Compared to last December, upfront fee incidence for new loans is sharply lower, while fee incidence on renewals was only down slightly. Upfront fee level in the right-hand chart decreased for new and renewed loans in December. Upfront fee levels on new loans were sharply lower from the year-ago period, while upfront fee levels on renewed loans fell slightly. The next slide looks at the upfront fees by industry. Upfront fee incidence in the chart on the left showed incidence rates equal to or slightly lower than last year across all industry sectors. When looking at upfront fee level in the right-hand chart, healthcare, mining and transportation, and retail and wholesale trade saw decreases, while accommodation, entertainment, and food, as well as manufacturing, increased from the year-ago period. The next, on the final slide of this section, we're going to look at other fee types. Each bar in the chart represents yield on other fee categories for the respective calendar year. Unused fees, shown by the blue section of the bar, make up the largest amount of yield in each year, accounting for 50% of the total for these fee categories. Year over year, there were small increases in each category, with the largest increase coming from the unused fees. That concludes the pricing and the fees section, and next I'm going to turn it back over to Jeremy, who's going to speak a little bit about the AFS guidance files. Jeremy?
Thanks, Rob. And I know we're coming up on the hour soon. We do want to leave some time for questions. But before we concluded, I just wanted to show you an example of how we deliver data and information to clients participating in our pricing service. And there's really two ways that we do that. The first is through an online dashboard, which focuses on high-level market trends and allows you to create similar views to all the pictures that you saw here in this webcast. You can think of it as a portfolio analytics tool and a market research tool, very much in line with the themes and the charts that we're seeing here today. The second is through a flat file delivery that we call a guidance file, which is more bottom up in its approach to analyzing pricing and analyzing opportunities. And we have a sample guidance file here on this slide. And what this does is it lists for a sample bank here, all of the new renewed transactions in the quarter down the rows, and then we have some indicative characteristics like the sector it belongs to, the line of business going across the columns, along with some measures of pricing and fees, like a LIBOR equivalent spread, an interest rate, an upfront fee level. But what's really special about this file is that for each bank loan, we can actually append a market equivalent rate, market equivalent spread and fee to every bank transaction in question. And what we do is we find all the loans in the database for the peer banks that share the same industry, geographic location, and so on, and then say, what's the average spread for that cohort of loans? It's not a regression metric, it is the real facts on pricing, so you can be very much confident that the spreads you see here reflect true market conditions. You can then array the loans by the difference between your bank's spread or your bank's interest rate versus the market average to quantify areas of strength and opportunity. I actually have an example of that here for the sample bank with that bar chart where we said, well, let's bucket all of the observations by how much they differed from the market in terms of interest rate. The picture here is normally distributed, but we do often see times where the bank can be as much as 100 basis points off the market average. And that's where the file really comes into its use. So we can then say for all those outliers, are they focused in a particular geographic region or industry? Can we filter for that and then address accordingly based on our bank's pricing policy? So we really do value the input and the collaboration with banks. This has been one great tool that we've had to have those discussions with banks around pricing opportunities. It's also really nice that if you have your own data lake or data mart, or if you built your own visualization tool, this can factor really nicely and be digested really easily into those kind of tools as well. All right, and then just a few thoughts to conclude here. So as Don mentioned, the US economy, it is strengthening, and that's going to be a really good thing for loan growth going forward. We do expect banks to hopefully grow the balance sheet more so in 2022 versus the preceding year. We did see, as we mentioned, a surge in new lending in December, as well as a big increase in line utilization. So again, some really positive findings to end the year. I do want to point out that a lot of that growth is concentrated in the financial insurance sector. And that's one to really keep an eye on because I do think there are some vulnerabilities there from a credit perspective. Then in terms of pricing, rates did come down year over year. That probably was expected, but I think the more interesting trend that we're seeing is that continued migration and adoption of SOFR, particularly in the bilateral space. What's really interesting, as Rob pointed out, is that SOFR has really been functioning similar to LIBOR over the last several months. The size mix, the risk rating mix, and the pricing really has been very similar. So the transition so far has been pretty smooth, and it'll be a really interesting dynamic moving forward. And we look forward to updating you on what those SOFR loans look like in the next year. The next slide, Lisa. So again, we really appreciate your time today. We know banks are very, very busy this time of year. Hopefully the analytics resonated with you. And as always, we're always available for questions. If you have questions about the market data or how our pricing service can help your bank, we'd love to speak with you. So Renee, I think we'll take these last 10 minutes to see if any questions come in. We'll be happy to answer those for you.
Thanks, Jeremy. We'll just give a few folks a few moments to pose their questions. I believe you very thoroughly covered all of the data that we found in the last year, so I'm not sure what questions will come up. Well, Jeremy, it doesn't look like we have any questions today.
Renee, actually, I do see one that came in about the guidance file, a question about whether or not we can customize some of the analytics there. And the answer is yes. Depending on what parameters are most important to your bank, we can incorporate some of the parameters in that file. Some banks prioritize collateral and size over, say, industry sector, and we can certainly work with you to tailor the level of granularity in that file, as well as the number of parameters in there. So it is not solely just one option. We can certainly work with you to make it fit how your bank prices and make sure it aligns with those strategies.
Thanks, Jeremy. Well, it looks like that's all we have for today, so we appreciate everybody's time. And as a reminder, we will be sending a email with this recording so that you can download or share it with a colleague. Thank you again, and we hope to see you at our next webinar. Have a good day.
Thank you, everyone.
Thank you, Renee.
Thank you. Take care.